Hello everyone, welcome back to our channel and welcome back to this video. This video is going to be dedicated to private credit again. We had done a previous video on private credit and we had talked about the democratization of private credit. This video again is going to be focused on private credit and we're going to talk about the forecast for private credit for 2026 and beyond. We are going to be talking about the private credit reckoning, that is when democratization starts meeting reality. The private credit industry is experiencing its first meaningful stress test since the retail investors flooded into the asset class. Redemption requests have surged across the largest funds marketed to wealthy individuals, with some seeing withdrawal demands from 5% of the shareholders. And what is being reported is that one Blue Owl fund is receiving requests for roughly 15% of its shares, primarily from the Asian clients. Now, this democratization arrives at a particularly inconvenient moment. The current US administration is actively working to expand private credit market access to the 401k plans, while the fund managers continue their aggressive push to democratize what were once only institutional products. The timing forces a fundamental question. Are these products genuinely appropriate for the individual investors, or has the industry built a structure that works brilliantly until it does not? Let's try and understand the mechanics of retreat. The redemption wave has hit the industry's flagship vehicles. Blackstone's VCRAT saw 4.5% outflows. Blue Owl's largest fund experienced approximately 5% redemptions. And Ares Management BDC faced 5.6% withdrawal request. These numbers may appear modest, but they are testing 5% quarterly cap that defines a semi-liquid fund structure. Fund managers attribute the outflows to fear-mongering around the corporate defaults. Companies like First Brands and the auto lender Tricolor made headlines with fraud allegations. However, the more mundane explanation is simpler. Returns have compressed. Total returns from the five largest private credit funds targeting individuals averaged 6.2% through the first 9 months of 2025, down from 8.76% in the same period of 2024 and 11.39% in 2023. This trajectory was actually very predictable. BDCs generate returns primarily through floating rate loans tied to the benchmark rates. When the Federal Reserve raised rates aggressively to combat inflation, these funds delivered double-digit yields. As rates normalize, so do the returns and dividends. Several funds have already cut distributions with more reductions expected. There is also structural tension that we need to take into account. Private credit actually evolved to serve institutional investors, for example, pension funds and insurers with decades-long liability who don't need liquidity the next quarter. The semi-liquid fund structure attempted to bridge the gap between the illiquid assets and the retail investors' shorter time horizons by offering quarterly redemption windows capped at 5% of the shares. Now, the design contains an inherent contradiction in itself. When the markets favor the asset class, the liquidity constraint is invisible. When the sentiment shifts, the gates become apparent. Blackstone's real estate fund provides the template. After the pandemic crashed office markets, redemption requests exceeded caps for an extended period and investors complained of feeling trapped. That particular Blackstone fund has never returned to its peak size. Blue Owl's response to the current situation offers a creative, if paradoxical, solution. Rather than capping the redemptions at 5% of its technology-focused BDC, the firm raised the threshold to 17% and borrowed money to fund payouts. The goal out here, to flush out all the sellers at once rather than endure years of redemption requests. About 15% of the investors accepted the offer. Now, this approach by Blackstone represents the exact opposite of what the semi-liquid product was designed to do. The structure that was supposed to provide measured liquidity is being abandoned precisely when tested. Let's also talk about the distribution challenge out here. The redemption dynamics illuminate broader concerns about how these products reach the investors. Major brokerages, that is UBS, Wells Fargo, distribute these funds to thousands of financial advisors. Blue Owl's technology BDC grew to $6 billion largely through UBS wealth management platform, with particular penetration in Asia. The distribution model creates potential misalignment. Advisors earn fees from placing the clients in these products. Clients hear about the 10% yields without fully internalizing the volatility, liquidity constraints, or the rate sensitivity. When the dividends decline, the disconnect becomes apparent. Now, the concern is not hypothetical out here. Industry observers note that less sophisticated advisors may not adequately educate the client about the risk. The products work for investors who genuinely understand them and have appropriate time horizons. So when we are talking about distribution, the main question out here is whether the distribution infrastructure ensures that matching occurs. Let's also focus on the policy dimension out here. Now, the current stress arrives as the current US administration is pursuing rules that would reduce legal barriers to including private funds in 401k plans. Fund managers have advocated for this democratization, arguing that all investors deserve access to alternative investments that can deliver higher returns and portfolio diversification. The counter agreement centers on suitability. Unlike wealthy individuals who qualify for current semi liquid funds, 401k participants particularly have shorter investment horizons and less financial sophistication. They may also have immediate liquidity needs, paying for medical procedures, funding education, etc. And these may conflict with the private credit structural constraints. Another important thing to note out here is that few US companies have been willing to include private funds in their 401k offerings, fearing class action liability over fees and suitability. The current redemption surge provides fresh evidence for that caution. So, what's the forward view for 2026 and the future? Now, despite the redemption pressures, private credit funds are still taking in more money from new investors than they're paying out in redemptions. The asset class retains appeal, and the industry has grown to roughly 450 billion in BDC-managed assets, triple the 2020 level. The critical question is whether the current outflows represent a temporary adjustment or the beginning of a cyclical pattern that could snowball. If the redemption requests continue exceeding caps, or if the fund managers must increasingly borrow to meet the withdrawals, the semi-liquid structure's viability comes into question. We have to understand that what we are observing is private credit's first real encounter with behavioral patterns that have always characterized retail investing: enthusiasm during appreciation, exit during disappointment. The industry built products assuming investors would behave like institutions with long-term horizons. The current episode is testing whether that assumption holds. The outcome will shape both the industry's product development and the policy debate around democratizing private markets. If managers can navigate this period without prolonged outflow cycles, the argument for broader access strengthens. If the structural contradictions prove untraceable, the case for keeping these products institutional becomes more compelling. For now, what we can say is that the industry is facing an uncomfortable test, one that may prove more instructive than years of strong returns in revealing whether private credit is genuinely suited for individual investors. Now, this is what we wanted to share with you in this follow-up video. Hope you've enjoyed this video. Stay tuned in for our next one.